Okay, welcome to the November Chemical Consultants Network meeting. I'm Mike Michaelzek, the chair of CCN. For those of you in the audience that don't know, Chemical Consultants Network is a group of chemists and chemical engineers that provides guidance, advice, expertise, and resources to our members who are in consulting or are interested in consulting. We're a topical group of the Philadelphia section of the ACS, and we're also supported by AICHE. We hold monthly meetings of interest. This is the November meeting. And for $35 per year, paid members can create a web page on the CCN website to attract potential clients. If you're interested, sign up on chemicalconsultants.org and become a member, just like PBS. It'll be a good use of your money. So tonight's speaker is Wendy Bleczinski. So Wendy is a tax, estate, and business attorney in Pennsylvania and has worked for more than 25 years with individuals and businesses on tax and business solutions. Wendy's also has a BS in biology, so she's got a science background and worked as an environmental scientist before becoming a lawyer. She's also the attorney that I use for Key Lake Consulting, my consulting business, so I thought I'd mention that. And her talk tonight, Consulting in the Law, will hopefully provide guidance for folks that are just starting consulting or maybe need a little brush up on legal matters, or maybe people who are established just want a refresher of what you need to do. So anyway, I'll let Wendy talk, and I'll shut up, and we'll start the seminar.
Hi, thank you for having me. As Mike mentioned, I'm Wendy Bleczinski. I'm a tax attorney out of King of Prussia, Pennsylvania. I've been doing this for, as Mike mentioned, over 25 years, advising clients, helping with tax, estate, and business planning. But tonight, obviously, I'll focus on the business and tax issues, and in particular, how they may apply to consultants. When I was asked to speak, I was told there'd be a mixed audience. I'm looking for the basics. Others may be wanting a higher level look at the issues facing consultants. So tonight, I'll start with what I consider the basics, questions most people ask when they're considering going out on their own. And I'll touch upon a couple more complex issues, but also hope to incorporate your questions to target those as well, which leads me to a couple of disclaimers. First, I said this to Mike, although I've done many virtual meetings since the start of the pandemic, this is my first virtual presentation. So I apologize in advance if I'm looking at the wrong place. I never know where to look. And for any technical issues. I think we clarified that I'm going to take questions. You can unmute and ask questions at a certain point. If you do want to ask something, during, just use the chat maybe, and I'll have that up and take a look too. Second, I am an attorney. This presentation is for informational purposes only, shouldn't be used as independent legal advice. And you should feel free to contact me. I have my website and my email address here if you have specific issues you want to discuss. But I'd also encourage you to explore any topics with your own tax and legal advisors. A lot of clients don't know where to start or don't know what questions to ask. So hopefully this can provide a starting point to help you formulate those questions. Let's go to the second. So tonight I'll focus on the legal and tax issues that I'm usually asked to address, whether someone's starting a business or has been consulting for years. I will assume, however, that we're dealing with like single owner structures versus multiple owner structures. And again, I will probably touch upon some of those multi-owner issues, but the focus or most of the things I'm going to talk about are geared towards the single consultant. The issues I'm asked the most about are liability, taxes, and entity structure. Liability, usually it's how do I protect myself? How do I protect the business? How do I protect my personal assets? Do I need insurance? And then, of course, what business structure will provide the most protection? From a tax standpoint, a lot of people are in the employee realm, and when they're crossing over to being a consultant, so they've been paid via a W-2. So, when you're on your own, it's a whole new tax structure. So the questions are, what taxes do I have to pay? how do I track the income and expenses? You know, what can I deduct? When do I pay the taxes? What's the best structure from a tax standpoint, you know, business-wise? And then lastly, entity structure. You know, usually it's the call, starting my own business. Do I need to incorporate? And the answer is maybe, but you know, that's starting a corporation. There are a lot of other good options today. So we're usually looking at the specific situation and deciding, you know, which entity structure is best for your business. Look at the pros and cons of each. I can often, when I'm talking to someone, hone into, you know, we're dealing with just 2 or 3 options, but for this presentation, I'll review, you know, about 5 different entity structures and talk about the pros and cons of each. So liability, I'm sorry, this is a technical difficulty now. You know, when you're starting a business, usually people want to know, what is my risk exposure? And to understand that, it's really important to understand the different types of liability. So you're starting a business and you're going to do things within that business. So you're going to, you know, provide services, enter contracts, potentially take on some debt, perform services. And so the actions that arise or liabilities that arise within the business are limited to the business assets. So in other words, if you get sued for something you did wrong and caused some harm to a client or a customer, the business assets are the only assets that would be at stake there in that issue. Outside liability is personal liability, something that happens on your own time. You get in a car accident, you know, have a judgment against you. Your personal assets are going to be open to liability. And interestingly enough, and this is why I usually bring it in, is that now your business is going to be considered a personal asset. So it's kind of like the business is contained. However, if you do something personally, there is a chance that the business could be pulled into that. So we kind of have to think of exposure from both inside and outside. And, you know, most people think of professionals like doctors and lawyers when they're thinking about liability exposure for someone who's on their own, but any consultant providing a service can be exposed to liability. The level of risk of liability in your consulting work will depend on what type of services you provide, but it is always important to consider putting layers of protection between your business and your personal assets. The first layer, usually insurance. Most businesses, regardless of what other protections you decide to put in place, you know, have some kind of insurance. And again, consultants are usually providing some kind of professional services. So we're usually looking at a professional liability insurance, you know, or errors and omissions, I can say that, insurance policy. And that's, again, recommended if you're providing services for a fee, which is all of you likely. And this safeguards against claims for unintentional mistakes, inaccurate advice, you know, and general negligence. The commercial general liability insurance is going to protect if a client files a lawsuit saying you caused some business interruption or financial loss or breach of contract or you know, things like that. Okay. Oops, there's my. The second layer of, you know, liability protection we usually talk about is, you know, the entity structure, which I will get into a little bit more later. But, you know, which entity you choose, and the 4 listed here are the ones that can provide owners a level of liability. The one not listed that we'll talk about is a sole proprietorship, and that doesn't provide it. But, you know, choosing which entity to run your business out of is going to be your second layer. So your first layer is always going to be insurance, usually. Second layer is entity, choice of entity. And then the third that I often see is, you know, all consultants usually, you know, enter into contracts that delineate their services. You're not going to just rely on a verbal agreement. Most times you're going to enter into a written contract. It's going to dictate, you know, what services you're performing, how you're performing them, when you're performing them, how you're going to be compensated for them. But in addition to those provisions, you're also going to have all the legal provisions, such as, is there going to be a limit on liability? Is there going to be a dispute resolution mechanism within the contract? And those, again, they vary, agreement to agreement, and it's important to get those reviewed. But to the extent you can place those limitations and get those in your contracts, that's, what I consider the third level of liability protection. So, insurance is usually a given. Entity structure is something that most consultants will look at the risk exposure of their particular field and their particular services and say, do I need, another layer of protection? And then everybody usually has some layer of protection in the contracts. Also, once you've decided to go out on your own, especially if you were an employee prior to starting this new consulting business, it brings about a new set of tax issues. Most people are used to being an employee and receiving a W-2, and your employer withheld your taxes. They paid half of your Social Security and Medicare taxes due directly to the IRS. And they also withheld the other half and submitted that to the IRS as well. Now, if you're on your own, you're earning more than $400 in a tax year, you'll have to report everything you earn. But the upside is you'll also be able to deduct many items that you couldn't as an employee. The key here is there's a transition, though, from being, an employee paid with a W-2 where your employer is reporting your earnings to the IRS to being someone that's on a self-reporting method. You are now in charge of, keeping track of reporting your income and your expenses to the IRS. And that's, again, usually a big adjustment for most people. And again, the biggest adjustments from a tax perspective for most people are dealing with self-employment taxes, the estimated tax payments, what kind of tax return do they need to file an additional tax return, and the tracking of income and expenses. So for self-employment taxes, as I mentioned, you're an employee, you have a W-2, your Social Security and Medicare taxes were, half paid for, half withheld and submitted. Now you're going to be in charge of doing that on your own. So that's going to be part of your tax return on a personal level. So for all self-employed persons. And basically, you're going to have a 15.3% tax on all earnings up until the Social Security threshold, which for 2021 is, it says that they're 142.8, and then 2022 is 147, and then 2.9% on everything above that. But to, again, mimic, what an employer is doing, they also give you an above the line deduction for half of your Social Security, self-employment tax, because that's what the employer would be able to do, deduct the part that they're paying on your behalf. So that, again, that's a big transition and a lot more tax liability from an individual perspective. The second thing that most of my clients that are going out on their own ask about is they've heard about estimated tax payments. And basically, this is mimicking the federal withholding, federal, state, and sometimes local withholding. The IRS asks you to analyze every quarter what your income and expenses are, and to pay, in the tax that you're projecting would be due on those. Two things that I think are interesting here. One is most entities, or most self-employed single owner entities are going to be pass-through entities where the income and expenses are going to vary throughout the year. And you're really not going to know what your net income is until December 31st. So the IRS allows you to take the position, whether you're a sole proprietor, an LLC, a limited liability, or a limited partnership. If you're any kind of pass-through entity, an S corporation, and I'll explain that in a minute or two, but they allow you to take the position that you won't know what your income is until December 31st. So if you are disciplined enough, you can pay all of your estimated taxes on January 31st and not incur a penalty. So that's, one thing. The second is some people will, I guess they'll ask, what is the downside of not making your estimated tax payments? There's a penalty. I have many clients who decide that the penalty is, less than what they could earn paying in their estimated taxes. So they make a financial decision to just pay their taxes on April 15th or whenever the payment due date is. In addition, there is a safe harbor. So again, this is all at the personal level that you're looking at your, whether you need to pay estimated taxes or not. This is, there's income from the entity that flows through to the individual. And you look at, that in addition to your other income, in addition to your other withholding, and you have a tax, say in 2020, you have a tax liability of $100,000. For 2021 tax year, your estimated payments will be considered, to meet the safe harbor if you pay in 110% of that $100,000 tax liability for 2020 and 2021. In addition, if you had paid in 90% of the tax owed in the current year, or the 100, actually it says 100 there, I apologize, that should be 110% of the prior year. In addition, again, I had mentioned people are, actually, I didn't mean to apologize. Estimated tax payments. Okay, the tax return. Where are you going to be reporting your income now? That'll depend on what kind of entity you have. So, a sole proprietorship and a single member LLC will actually still just be on your individual income tax return on a Schedule C. So you won't have an extra tax return. All of the other entities would have an additional tax return that has to be prepared, where the income in all but the C corporation would flow through to you. Again, as I mentioned, with this new tax regimen, you are self-reporting your income and deductions. You have to keep track of those. People often ask me, how do I do that? What's the issue there? And usually it's a matter of looking at what the IRS would require. So we look at, income. It'll be reported to you through, any income you earn from, a client, a customer, will likely be reported to you through a 1099, whether that's a 1099 NEC or a 1099 miscellaneous. So the IRS will have an independent verification of that income plus any other income. But usually when we're dealing with an audit and they're looking at, your income, they're going to look at your deposits in your business account. So again, it's important to keep your business accounts separate. It's important to deposit everything, and it's important to report everything that gets issued a 1099, to which you get issued a 1099. Expenses, they must be ordinary and necessary to the business. Again, important to retain proper documentation. Red flags, usually, just excess deductions, especially if you have losses. And that's usually like the first year or so in a business, but most consultants that I know, because the expenses are fairly low in most fields, do end up having income reported. So that's actually good. So there's less red flags. There are some accountants that I've worked with who think that Schedule Cs, so in other words, sole proprietorships or single member LLCs that are disregarded and report their income on a Schedule C are more likely to be audited than the separate business returns. So again, something, one of the reasons that people like a separate entity that has its own tax return. But if I'm going to be honest, I've seen, audits of both fairly even. Deductible costs, I'm usually asked, are my startup costs before I'm even operating, and officially, working and having clients and customers, are they deductible? And $5,000 is, and the rest of it is amortizable or deductible over 15 years. So, it's important to keep track of all those costs. You may not think they're much, but it can add up, and it is deductible, and it does, offset income. And again, that's one of the nice things about being a consultant or your own business versus an employee, is that these things that, you're paying for can be deducted and offset that income. Self-employed health insurance is 100% deductible for you, your spouse, and your dependents, which is nice. As I mentioned, half the self-employment tax. Home office, this has been especially important in a pandemic. A portion of your home, if you're using that as an office, as a dedicated space to work, you can deduct costs associated with your mortgage interest, your real estate taxes, insurance, utilities, so repairs, depreciation on the cost of the home in general. So that provides a nice deduction. And what's interesting, again, to me as a tax attorney, is prior to 2017, W-2 employees could do something similar for their unreimbursed expenses if they were required to work at home. But that was eliminated in the 2017 Tax Act. So this is really only available for consultants or people, who have their own businesses. There is also a simplified method of $5 per square foot for the home office. And that comes with less audit issues. I apologize. Someone just asked about Medicare costs. So the premiums that you pay for the extra, I'm losing the term for them, but the other policies, yes, they should be deductible as self-employed health insurance. Did I answer that? Travel, we've had less travel and auto expenses the last year or so, especially, for example, you don't have to travel to give this presentation. But to the extent you do have them, I would keep track of them. I have done several audits, and that's usually the stickiest part of it. So if you do, travel for your business, and commuting's not counted, but one of the nice things of being a consultant working out of your home, that's your business. So if you're going from a business to a client, that is not commuting, that is travel for business purposes. So you can track your mileage there, and you can either, take the mileage deduction, or you can, do an expense version, so you can get a portion, percentage of the expenses related to your auto. You can always get direct travel costs like tolls, parking, things like that. Advertising and marketing, that's deductible. I do note that sometimes, you can make charitable donations, and those are limited to $250. However, if you do end up making a charitable donation and it is promotional, for example, you're giving to American Cancer Society. However, for me, they refer me business sometimes. So, for me, that can be a marketing versus a donation. So you just have to be careful how you categorize that. I would say the obvious, but subscriptions and memberships, such as the membership to CCN would be deductible. Supplies, legal and professional services, insurance costs. I actually, through research and development expenses, there's a very nice, research and development. I think it's a $50,000 expense that's allowed. So if that's applicable to you, it's a very good deduction, for lack of a better word. State and local taxes. So to the extent you pay state and local taxes on your income associated with your business, you can actually take those as a deduction the next, for that tax year. The only caution there is, for Pennsylvania, for example, if most of my income is related to, my Schedule C or my, partnership or my LLC, I can actually take that as an offsetting expense on my Schedule C. However, I have to pull that back for Pennsylvania purposes because Pennsylvania doesn't. Yes, it is difficult to claim the R&D expenses. They have very rigid rules, but if you do, it's a good payoff if you do qualify. I actually looked that up the other day, and as you said, there are a lot of requirements in order to qualify for that. Business gifts, $25 per person. Sometimes we can get around that by giving awards. In addition, Section 179 is a very good provision in that there are lots of things that would be depreciated. In other words, equipment, computers, machinery, big, more capital expenditures that the IRS would generally require you to take over the useful life of that asset. In other words, if a computer costs $3,000, they would say it has a 5-year life. So you would take, that deduction, a little bit a year over 5 years. But Section 179 will allow you to expense that in the year you purchase it. There are some limitations to that too, but and you do need income to offset that. That can't help you generate a loss, but overall, most of my clients are able to utilize that. And then anything else that you can't use, depreciate or take as an expense under Section 179, you can depreciate or amortize over time. One of the nicer deductions is the qualified business income deduction that it passed as part of the 2017 tax law. It began in 2018 and it's here through 2025. And it basically is a deduction for a taxpayer other than a corporation. It includes sole proprietorships, S corporations, partnerships, which an LLC is part of that. It actually also includes trust that own an interest in a pass-through entity. But this deduction allows you to take 20% of the net income from your business and deduct it as an above-the-line deduction. There are limitations. Most consultants will fit in the specified service trader business, literally because consulting is considered a specified service trader business, just like lawyers. The two fields that were initially in, the definition that got removed were engineers and architects. So they obviously had a very good lobby. But to the extent you are in one of these, fields, this again, the specified service trader business, which consists of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trader business where the principal asset is reliant on the reputation or skill of one or more person. Again, the definition of most consultants. In that case, you're only going to be allowed this deduction to the extent your personal income tax return, if you're married, filing joint, is under $415,000. It starts getting phased out at $315,000, but if you're making more than $415,000, you're not going to be eligible for this deduction. If you're filing single, that range is $157,500 to $207,500. It's also limited to the extent that it exceeds 50% of employee W-2 wages. Just in general, there's another limitation as well, but that's the one that usually applies. However, there's an exception for those who on their personal income tax returns are under $315,000. We don't have to look at the wages. So that's how sole proprietors and other people who don't necessarily pay themselves wages or don't necessarily have employees to pay wages to are able to utilize that deduction. But again, it has proven to be the piece of the Tax Act that has provided the most benefit to my clients, because it is a good, basically you're recognizing 80% of your income if you qualify and are within the thresholds. The other thing that a lot of people come in when they're setting up their own business, they're asking, is there a way to sock away a bunch of money for retirement and deduct that? And yes, there is. The SEP and the individual 401k are better than the simple IRA in the sense that the limitation on what you're able to contribute and deduct is higher. So for those, you can contribute 25% of your salary up to a max of, for 2021, it's $58,000. The individual 401k is only designed for an individual owner, his or her spouse, and maybe another shareholder. So it's not designed to have employees, whereas the SEP is a vehicle that can be used for an employer, for a consultant who has other employees or not. And you contribute 25% of, everybody's salary. So it would be, your salary and or any employee salaries, and you have to use the same percentage. You don't have to contribute every year. You can, as the employer, determine what to contribute every year, but all of the contributions are deductible. The simple IRA is for small businesses, owners who have employees, and it's very similar to a 401k for a bigger company, where you can allow the employee to have and yourself to have elective deferrals, and then as employer you can match, I think there's a set match of 2%, or you can choose to match 3%, or it's matched up to 3%, or contribute 2%. The limitations here are the same as the 401ks. It's 13.5 for 2021, so it's significantly less than the SEP and the individual 401ks. So those are usually especially the SEP is very popular because you can, you get a deduction and you can put it away for retirement. So that brings us to choice of entity. And so the five that I plan to review are sole proprietorship, C corporation, S corporation, limited partnership, and limited liability company. A sole proprietorship, many people choose to start here. This is not a separate entity, even if you choose to obtain a fictitious name or DBA, which if you do land on this entity, I usually recommend that you go with this option. You can also get a separate EIN. Again, still not a separate entity, but at least you're not using your Social Security number. So this is helpful because those who are paying you we'll ask you to fill out a W-9 request for taxpayer identification number, and that way you don't have to give your personal information. The upside of a sole prop is it's very easy. It doesn't have any filing requirements with the state. It's not a separate entity. There's no formal corporate maintenance requirements. You don't have meetings or minutes. It's just you. Your incomes and deductions are reported on Schedule C. So no additional tax returns required. And it's just you. So generally, if you terminate or the entity, or if something happens to you and you pass away, there's nothing, it's not very hard to wrap up. The downside is that there's zero liability protection. If you're sued as part of the business and your personal assets, to the extent they're not otherwise protected or fair game, if you default on a business loan, you're personally liable. Practically, however, many do choose to obtain, to stick with a sole proprietorship, obtain insurance to cover the potential exposure, and start here with a separate fictitious name and EIN. And then if things ramp up, they can easily create an entity to provide other benefits. A C corporation for a consultant is overkill and usually not even in the discussion, but I'm putting it out there, just because you often, when you're saying, should I incorporate, you're really talking about, should I create a C corporation? And again, from that standpoint, the answer is usually no. It's usually for a bigger company, one that needs, wants a lot of shareholders, or some, even smaller ones that want to go public. The benefit here is, you must file formal paperwork with the state to form this. There are formal meeting requirements and annual minutes. There's special, if you have any significant event or purchase that occurs throughout the year, you have to have special meetings and minutes. And then, lastly, and this is if you have multiple owners, you're going to want a shareholders agreement to, dictate the operation, how income's paid out, how distributions are made, what happens if somebody passes away, how, restrictions on transfers of stock, things along those lines. The upside, owners have liability protection. A lot of fringe benefits can be deducted by the corporation, which is different, which is not the case with, the next one, which is an S corporation, where a lot of fringe benefits for someone who owns more than 2% of a interest in an S corporation are not deductible at the entity level. And again, so they're usually larger entities that are going public. Downsides, the corporate formalities do need to be maintained in order to retain that liability protection. It can be pierced. If you hear about piercing the corporate veil, that's, because either there's, fraud, or that people are commingling their personal funds with the corporate funds, or they're not leaving enough money in the entity, not enough capitalization to run the entity. So it's really a matter of, some C corporations owners use it as their personal, checkbook. So it's not you have to abide by the formalities, and it's always good practice to, separate your business finances from your individual finances. And you would be surprised at how many people commingle those, and that's problematic from a corporate standpoint and a liability standpoint. Again, a downside, sometimes it can be a downside for a lot of people. They have to, pay for and do a separate tax return. The upside is that there's a separate tax return that provides a layer away from your personal income tax return. And the biggest problem with the C corporation from a tax attorney standpoint is that the profits are taxed at both the entity level, and then if you want to get those profits out to an individual shareholder, they're paid out as dividends, and then they're going to be taxed again on the individual's personal income tax return. So there's a double taxation issue. The rate right now is fairly low, but there is talk of it going up, but not that was on the table for a little while, and now it seems to be off the table for now, at least. S corporation is a separate entity. It has the formalities of filing with the state. So usually what you do is you file for a C corporation, and then you have to elect S status with a separate filing. It has the same corporate formalities as far as minutes and meetings as a C corporation. It does have some restrictions, though. It is limited to, it's limited to 100 shareholders. I'm not sure. I have 75 here. That's an old reference, so I apologize. And there's a limitation on who or what can be a shareholder. So a foreign entity or a foreign person cannot be a shareholder. Another corporation, in most circumstances, cannot be. A trust, again, except for in very limited circumstances, cannot be a shareholder. So it's a little bit more restrictive as to who can participate. But the benefit is that, let's see, the upsides has the same liability protection as a C corporation. In other words, the owners have limited liability. It is a pass-through entity, however, for tax purposes. So there is no tax paid at the corporate level. It's all passed through to the individual. So any income, net income that is earned by the S corporation would pass through and be recognized by the individual on individual income tax return. Most people, the biggest benefit for most people of an S corporation over other entities is that income distributed to a shareholder is not subject to self-employment tax. The problem you have with a consultant is most of their income is going to be related to the services you provide, so you can't really separate what's considered your self-employment earnings or your earned income from what would be just a distribution. If you have other employees or have other things going on with the entity, sometimes you can separate this. But again, the benefit would be that a certain piece of it, of the income could be paid to you as wages, but the rest could flow through as S corporation income, and in concept, that the wages are subject to the employment taxes and the income distribution is not. But again, it's not really applicable in a consultant situation. So it's not always the best choice, and I'll get to the best choice at the end. A benefit of an S corporation, which again is also a benefit of some of the other entities, is that you can use the loss if you have a loss against other income on your personal income tax return. Downside: corporate formalities need to be maintained in order not to have your liability pierced. Separate tax return needs to be filed. Again, sometimes that's an upside, sometimes that's a downside. There's a limitation on who can be a shareholder. I do have the 100 there, limited to 100 shareholders. Another one is that income distributions must be made in accordance with the percentage of ownership interest. So you can't do unequal distributions, and sometimes that's important for people. And again, that's more in a multi-member situation. Can't have more than one class of stock. Again, more important in a multi-member situation or a multi-shareholder. And then, as I mentioned earlier, when I was talking about the C corporation, fringe benefits are limited for owners who own more than 2% of the shares of the corporation. So to the extent that they pay for health insurance or other fringe benefits that aren't allowed to be paid for, they're going to be included in your income or as a guaranteed pay, as a actually for an LLC is a guaranteed payment. So they're going to either be included in your wages or included somewhere else. Limited partnership, we don't see much anymore. And the reason is, it is a separate entity. That's a situation where you have more than one owner or partner, and you have to have a general partner who is open to complete liability, personal liability, and then a limited partner. The general partner historically has, people form another, like an S corporation or something to be that general partner. So that's how they, protected, made it so that the general partner's liability was limited. And then the limited partners, to the extent they're not in the management of the, not involved in the management of the entity, have limited liability. However, again, in a situation where we have consultants, even if you have multiple, usually you have some, a lot of active participation. So it's not going to be a very helpful entity, but I just mentioned it because it was used in the past. Again, it is another pass-through entity. One of the nice things is that there's no formal meetings or minutes required. It provides limited liabilities to those partners who don't participate in management. And here's the difference between an S corporation. Income can be recognized or is generally recognized on a percentage of the ownership, but special allocations can be made. So if one person contributed more than others, they can be paid back first. So there can be some special allocations. So that's usually nice. Downside, again, separate tax return. General partner has no liability protection, and limited partners have no management authority in order to get their liability protection. And so here is where we usually land. So we're usually choosing between, for a consultant, we're usually choosing between an S corporation and a limited liability company. Again, this and the S corporation are the most popular entity choices for consultants. It combines a corporation's liability protection with the pass-through structure of a partnership. It is a separate entity. There are there are formal filing requirements, so you do have to file something with the state in general. But it can be formed with one or more owners. So you can have a single member LLC, and it is going to provide liability protection. If you have a single member LLC, you can elect to have it taxed as either a sole proprietorship, so a pass-through entity on your Schedule C. You can choose to have it taxed as an S corporation, because sometimes some people like to do that if they have separate wages versus just income distributions. And then you can actually also have it as a C corporation, but again, I'm not sure why you would choose that. Again, upside, you have the liability protection with the pass-through structure of a partnership. It can be formed with one or more members. The IRS allows the LLCs to choose how they want to be taxed. There are no formal maintenance requirements unless otherwise agreed to in an LLC. In other words, you don't have minutes, you don't have meetings. If it's more than one person, you do want an operating agreement that is basically the agreement where you decide how you're going to run the business, how you're going to distribute any income. If there are going to be special allocations, so it has the benefit of a partnership if it's multi-member, and that you don't have to distribute income in accordance with the percentage ownership. And again, it has the pass-through treatment, so it's not taxed at the entity level, but only at the individual level. The downside is that it does have a separate tax return. All income is subject to self-employment taxes. So unlike an S corporation where you can, separate the compensation versus another income component that's not related to compensation, and that piece is not subject to self-employment taxes. The IRS takes a position that all LLC income, whether it's disregarded entity or a partnership, is going to be treated as taxable for self-employment purposes. Honestly, the IRS has been looking to close the S corporation loophole for years, but it hasn't yet. It's still there, but I, again, don't have many consultants who are able to utilize it because of, yes, if you own an LLC, you have liability protection. Whether it's a single member LLC or a multiple member LLC. That was a question. Someone was confused. If I own an LLC, do I have liability protection? You do. So now is where I was thinking I would take some questions. There are, some practical issues here that are often asked, and again, that's their particular situation to situation. If you are going into business with someone else, what are your considerations? What if you decide to hire employees or other consultants? How do you go about doing that? What are the issues there? Big thing I see with most consultants working for someone, especially a bigger company, is they're going to be asked to sign a confidentiality or a non-disclosure agreement, but that can also go the other way. In other words, you may have proprietary information that you want to protect, so you may want to present your client with a confidentiality agreement or a non-disclosure agreement. Obviously, contracts, you could probably have a whole separate presentation on that. In addition to, licensing agreements and things that protect your proprietary information. Again, I was just kind of going through questions I get, and people are always like, how do I pay myself? And that varies, from entity to entity. So usually it's part of the trackings, so you can either for, a sole proprietorship, you pay yourself by giving yourself distributions and tracking those. All of these entities, you're basically going to be taxed on your income less your expenses. However, what you take out and how you take it out, some people take it out as wages, some people take it out as just distributions, but you will deal with the Social Security and Medicare taxes either as an employee if you pay yourself compensation, or as taxed on the pass-through income as self-employment taxes in general. But I can go into that a little bit more. There are other just considerations. At this point, I'd like to open it up to questions to see what is more. So someone has asked, can I claim R&D expenses for research I do myself, or the expenses have to be paid to another company? That is a good question. And I apologize for not knowing the answer, but if I can get back to you on that, I will definitely do that. But I believe it's research you do. It can be for research you do yourself, but it has to be qualified. There's a number of requirements for the research. In other words, that the research has to be a certain kind of research for the benefit of, it has to be truly exploratory and not, I don't know what the right word is, but it's not dealing with something like confirming something current, but actually truly discovery based. But I can get back to you on that, but I believe it is for research you can do yourself. Is there anybody who has any questions?
Any questions? I just have a comment, Wendy. I think your thing about the SEP plan
Yeah,
was really good because I used that for my company and I was able to sock away a lot of money.
yeah, that's
With an LLC with only me as the employee.
right. Exactly.
Really took away a lot of money pre-tax.
Exactly. That's, I mean, it's one of the, it is a really nice benefit. There are a lot of, actually right now, there are, I think, a lot of benefits to being a consultant versus an employee, whereas in the past, it was always the opposite. Go ahead. So the question here is there a limit to the self-employment tax an LLC has to pay? It's the same as, the Social Security limitation will be there. So to the extent you're under the 147, for 2022, or you're over that, you're going to only pay the 12.4% on the amount up to 147,000, and then everything, you're going to pay 2.9% from 0 to 500,000, whatever you make. So there is a limit for Social Security purposes, but not for Medicare purposes. Does that answer that question? For LLC, what defines the limit of financial liability? So for an LLC, and again, a lot of consultants don't necessarily have tangible assets within their LLC, and you're not going to keep a lot of cash there. So what happens is, if you are sued and there's a judgment against you and they're trying to collect, and it's for the business, only the assets of the business will be subject to liability. So they can't come outside of the business to your personal assets. They're limited to what assets the business owns. Does that answer that question? So there is no limit, but it's number wise, but there's a limit as far as what's in that LLC.
Is there any other questions?
I have a question.
Sure.
I have to admit I'm retired now and I'm not consulting. However, early on, we had when you're starting out in a consulting business, you have a lot of expenses. You buy a desk, a computer, a cell phone, et cetera, et cetera. And maybe you're leasing a car, and you don't have a lot of business. And so I thought at that time you were allowed to lose money for 2 or 3 years, just while you're building up your business. Is that still the case?
That is still the case. Again, sometimes it's a red flag for an audit if it happens too many years in a row. But they'll allow you to have losses for a couple of years without really questioning it too much. And then it's the extent of it. So, if you're talking $500,000 of losses, that's one thing. But if you're, in the 25 to 30,000 of losses for a couple of years before you're turning a profit, that's not an issue. The other thing I've seen is, them trying to call whatever you're doing a hobby. And I had a radiation oncologist where the guy, the IRS agent, was asking me if it was a hobby. And I said, I don't know many radiation oncologists use that as a hobby. And because he had a lot of losses, like you said, they will allow it for a certain period of years, but after that, unless it's, again, this radiation oncologist, he had legitimate losses year after year after year, which we wondered why, he kept doing it. But yeah, I think that's a very good point. I have another question here. Wendy, have you seen cases where clients willing to indemnify the consultant? I've been able to get some clients to do this, but usually not, of course. Client always gets indemnified. I usually fight for a mutual indemnification provision in the contracts. and have been successful. So yes, I have seen it work where, you know, the client will indemnify the consultant if you push for it. I am very adamant about getting a mutual indemnification. I'm like, sure, we'll indemnify you, but you have to indemnify us if you do something.
Is there anything else? Any other questions? If not, thank you, Wendy. It was a great talk. A lot of very specific information. I really liked it.
Yeah, I was gonna say I didn't know how specific to be. It's the lawyer in me, you know.
I think you gave a lot of information. Some people may have to digest it, but
Yeah.
but I thought it was great. So
Well,
thank you very much.
I appreciate it. All right. Well,
All
thank
right,
you.
thank you. We're done with CCN in 2021. Our next meeting will be January 12th, 2022.
Oh,
See
wow.
everybody then.
All right. Thank you.
Bye.
Thank you.
Okay.
Thank you.